how to pick stocks, when to buy stocks, and how to get rich. Hello everyone, my name is Alex. I hope you're doing well. I hope you're staying safe. Welcome to my channel where I talk about personal finance, invest in stock market, cryptocurrencies. I also try to spread the news that investing is very important. Come on people, if you haven't started doing that, you probably should do it right now. Did you know that actually 80% of Canadians doing some sort of investing? That's pretty cool, right? But also 80% of those 80% is doing that through mutual funds. Fees, right? That's pretty bad. Because you can lose up to 60% of your investments just to paying these fees. That's crazy. That's why it's important to understand what the stock market is, how you can invest in it on your own without paying a ton of fees on top of that. And the most important and the most common question that every investor is asking is which stocks I need to buy and when I need to buy those. That is exactly what are we going to be talking about today. If there is a magic pill to all of this, and there's a really good answer to that, just subscribe to my channel and watch my videos. Or buy a single ETF. I was actually talking about in one of my recent videos. Go check it out. And if you are investing on your own and you're picking stocks by yourself, how you can determine what stocks to buy and when to buy those. Overall, there are three main factors that I'm looking at, besides all other financial metrics and balance sheets and all that, that helps me to determine if right now is the best time to buy this stock or not. And I'm not saying this is a 100% rule that you need to use and it's going to work all the time. No, but it's one of the ways what can help you determine and give you a better perspective where this stock is right now and if it's a good time right now to buy it or not. And is also useful for situations where you want to compare multiple stocks within the same sector and determine which one is in a better state right now for buying opportunity. I personally use this technique as well when I'm doing the research around different stocks, different sectors, and when I'm trying to determine and make a decision what stocks I need to buy and why and when. And it seems to be working so far. I really like it. So let's see what we have here. And the first one is relative price to earnings ratio, or PE ratio. And this is a common metric to determine when the stocks are undervalued. In this ratio, the stock price is divided by its annual earnings, and then we have a number. The lower the number, the cheaper the stock. That's simple. It is basically a ratio that measures the current share price of the company to its price per share earnings. So this calculation kind of makes sense, and it can give you a really good understanding of what's happening with the stock right now. The one thing about this ratio is actually can be sometimes false positive, because earnings can be actually manipulated by some sort of creative accounting. You know what I mean? Also, some companies are specifically on purpose reporting false or lower earnings, but have strong cash flows. This would account for REITs companies, real estate investment trust. I actually talked about the best REITs in Canada in one of my recent videos, so you can go check it out there. And I often use PE ratio as my starting point when researching and comparing and finding strong companies within the same sector. PE ratio sometimes can be a very subjective metric if it's used on its own. That's why we need to account for other things as well. For example, let's compare two head-to-head competitors in telecom sector, Bell Canada and TELUS. Both are dividend growth stocks. I actually own them both. They're amazing. They have a strong mobile presence across entire Canada, and they are paying dividends regularly on the long term, and they're increasing dividends on the long term as well. And I will say that right now the PE ratios for both of these companies is on the higher end. They appear to be expensive. But you can see if you compare them head to head, Bell Canada seems to be cheaper than TELUS. And if you look at the company solely from the PE ratio perspective, you would think that Bell Canada is the better choice to invest in right now. But then if you look at the TELUS growth perspective, what the company is doing, how they're growing and what the business is doing there, and that Bell Canada is actually a lot of customers cutting their cable TVs. Yeah, who needs that these days? Then what would be a better choice, right? So it's hard to determine which company to use solely looking from the PE ratio perspective. Let's move to the next one and see if that can give us a better picture. So this one is average 5-year dividend yield. So another metric to see if the company is trading below its historical levels right now or not is to look at their 5-year average dividend yield. Remember, the dividend grows when the stock price goes down, and the dividend lowers when the stock price goes up. So say if the current dividend yield is higher than the 5-year average, then may be a good starting point for your research to see if the company is traded lower than it should be. But you also need to consider if the fundamentals of the company and financials of the company is on the good side, so the company continue growing in the future. For example, if you look at the TC Energy, as of today, their current dividend yield is at 5.8%, which is pretty good, but 5-year average dividend yield is around 4.5%. So it's lower than the current dividend yield, right? So this gives you a little bit of understanding where the share price is, and probably right now is a good time to invest in this company if you also believe the company is going to continue growing in the future. So as you can see, these two factors already can give you a really good understanding if right now is a good time to invest in this company or add to positions that you already have in your portfolio. Let's move on to the next one, which is actually a little more technical, but also a very good addition to the first two factors. So this one would be a technical analysis, like this graph here. Yeah. And we're going to be using technique as moving averages. So I use this basic technical analysis, or more specifically, long-term moving average analysis, in combination to the first two factors when I'm making a decision if I want to invest in this company or if I want to add to my already existing position for this stock. So I'm watching the stocks when they are on really good uptrend and then I pull back to their moving average, like 200-day simple moving average. And then I also add the first two factors we just talked about to make a better understanding of what the stock price is. And then if I think the company has a really good prospectus for the future growth, I invest. And this works really good for your current positions if you have something invested into. Say, for example, you have a BIPC invested, and on this graph you can see that there's a really good uptrend, then the stock pulled back a little, and at this point, if you think your other factors also lined up for the stock to be a really good investing opportunity, that's where I'm going to be adding more to my BIPC position. And now let's see if we can use it on paper and make a decision what are the best banks to invest in right now. Comparing big banks. From my experience, P/E ratio is actually a very quick and effective way to understand which stocks compared to each other are undervalued and where you want to put your money in. So here's a table for 5 big banks in Canada with P/E ratio, the current dividend yield, and the 5-year average dividend yield. And as you can see from our table, that if you use the 5-year average yield factor, then 4 out of 5 big banks are actually overpriced, which means that the current yield is actually below the 5-year average yield. Well, Bank of Nova Scotia is actually sort of in the same boat, just because their yields are actually the same. However, if I would be adding a bank into my portfolio today, I would probably add TD Bank, because first, the P/E ratio is lower than all the other banks, and second, because they're top 2 in terms of the market cap across all other banks. I also have a video where I go through financial sector and what are the best stocks, dividend stocks you can pick there. So go check it out. The link is here. So when building a dividend portfolio, the most important thing to look at is you need to invest into the strong companies. Over the long term, this company is going to keep paying dividends, keep increasing their dividends, and also keep growing their value as well. And they have to be the foundation of your dividend portfolio. And essentially, relative to the future, all of these stocks are undervalued. Yeah, if you invest in them today, they're going to be way higher, way better in the future. That's it. But also, if you're looking to add even more returns, more value to a portfolio, who doesn't want that? Then using the metrics, using the factors we just went through, will help you out with that, and you can buy the dip and increase your portfolio even more over the long term. Thank you for stopping by here. I hope you learned something. Let me know in the comments what are your thoughts. Like this video, subscribe to my channel, hit the bell, and I'll see you around. Thank you. Cheers. Bye.